Imagine your most important employee, the one who knows the largest clients personally, holds the operational knowledge nobody wrote down, or generates the relationships that drive your revenue. Now imagine they don't come to work tomorrow, permanently. Most small businesses lose somewhere between 30 and 70% of revenue when a key person dies. The relationships go cold, the pipeline stalls. The bank gets nervous about loan covenants. The lender may even accelerate the note. Key person insurance is what keeps a business alive long enough to recover, replace, or sell. I'm Micah Brown. I'm insurance licensed in Michigan, and I work with business owners on continuity planning. Today I'm going to walk through what key person insurance actually is, the four scenarios it covers, and how to size the coverage so it's an asset on the balance sheet, not a guess. So what is it? Key person insurance, sometimes called key man, but the language is shifting, is a life insurance policy owned by the business, paid for by the business, with the business as a beneficiary. The insured is a key employee or owner whose death would materially disrupt the company. If the insured dies, the business collects a death benefit. The proceeds give the business immediate liquidity to handle the disruption, paying down debt, hiring replacements, maintaining payroll, or signaling stability to clients and lenders. This is different from personal life insurance policy. The business is the policy owner, the premium payer, and the beneficiary. The insured doesn't receive any benefit personally, though they typically have to consent to being insured in writing. This is also different from buy-sell insurance, which we'll cover in a different video. Key person covers a business's loss. Buy-sell handles ownership transfer. So who's going to count as a key employee? It's anyone whose absence would materially hurt the business, usually one or more of the primary revenue operator, the rainmaker whose relationship drives sales, the technical or ops expert, the engineer, technician, or ops lead whose knowledge isn't documented elsewhere, the owner or founder, the person the banks lent to, clients trust, and employees follow, a partner whose responsibilities can't be easily transferred. Most businesses have at least one key person. Some have two or three. Many have more than they realize until they lose one. So, what problems do they solve? Well, one is revenue continuity. The clearest reason for key person coverage, if the key person's death immediately reduces revenue, the business needs cash to bridge the gap until revenue recovers, or until a smaller business model stabilizes. This is the most acute for service businesses, professional practices, sales-driven companies, and small consulting firms. The revenue is the relationships. The relationships are the person. The death benefit gives the business runway to keep employees paid, vendors paid, and operations running through the transition. Another option is if you have debt. Most small businesses' loans have personal guarantees from the owner or key principal. If that person dies, the loan may be called due, or the bank may revisit terms. Even without a formal acceleration clause, lenders get nervous when the person who built the relationship dies. They may freeze lines of credit, tighten covenants, or push for early repayment. Key person insurance can pay down or pay off the business debt, eliminating the leverage the lender has and removing the pressure that often kills small businesses in the months after a death. Another option is the replacement cost. Replacing a key person isn't just salary. It's the search process, the relocation if there are any, the signing bonus, the ramp up time, the lost productivity while the replacement learns, the role, the institutional knowledge that walks out the front door. For a senior technical role or relationship heavy sales lead, total replacement cost is often 2 to 3 times annual comp. Key person insurance covers this gap, buying time and capital to find the right replacement, not the available one. The next option is a transition runway. And sometimes the right outcome after a key person's death isn't replacement, it's a sale or wind down. A solo professional practice may not survive the owner's death. The right play might be an orderly sale of client files, sale of the lease, sale of equipment, and distribution to heirs. That orderly process takes 6 to 18 months. Without cash, the business can't operate through that window. Forced wind downs sell for fractions of what an orderly process would have returned. Key person insurance funds the runway for an orderly outcome, whatever that outcome is. How are you supposed to size coverage then? Sizing is a part most agents skip. The honest answer requires math, not a multiplier at the back of the napkin. Start with 3 numbers. 1, Projected revenue loss in the first 18 months after death. Most service businesses lose 30 to 70% of revenue. Service businesses with concentrated client relationships are at the high end. 2. Outstanding business debt with personal guarantees. The death benefit should cover this at minimum. 3. Full replacement cost for the key person, including search, signing bonus, relocation, and ramp time. And lastly, adjust for the tax treatment of the proceeds, which is usually favorable but worth running with your CPA. That's the policy size. Most businesses I see have either no key person coverage or coverage that's a third of what the math suggests. So, what type of policy is going to make sense here? Term, permanent, or both? Term insurance covers a defined period, usually 10, 15, or 20 years. It is cheaper. It works if the key person plans to retire or transition out within the term. Permanent insurance covers for life. It's more expensive per year. Cash value can be a balance sheet asset. It works if the key person is the long-term face of the business. Many businesses use a layer of both. Term for current revenue protection and a smaller permanent policy for long-term continuity. Retirement, buyout funding, or eventual buy-sell needs. Match the policy type to the time horizon of the risk, not the agent's commission preference. What about the taxes? Premiums are generally not tax deductible to the business. The death benefit is generally received income tax-free, subject to specific compliance with notice and consent requirements under IRC Section 101J for employer-owned life insurance. The written consent step is the part where businesses sometimes mess up. Without proper notice and consent before the policy is issued, the death benefit can become partially or fully taxable. This is one of those compliance items where doing it right at the start is dramatically easier than fixing it after. Work with someone who handles this regularly. Key person insurance isn't a luxury item. For most small businesses, it's the difference between surviving a loss and folding inside of 18 months. The coverage isn't expensive relative to the risk. The mistake is usually not having it, or having too little, or not structuring the notice and consent correctly. I built a free key person coverage worksheet that walks through the 4 scenarios, the sizing math, and the compliance items. DM me the word key person, and I'll send it over to you.